makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Boeing 737 MAX 9 fallout continues as United and Alaska Airlines find loose bolts on some planes, dealing another blow to the troubled plane maker. German industry shrinks for a 6 month as recession looms in Europe's biggest economy. Plus, the French Prime Minister, Elisabeth Borne, steps down as Emmanuel Macron seeks fresh momentum for his agenda ahead of the European elections in June. So welcome to the program. We have a lot of market moves, actually, so let's take a look at the European markets map. Now, of course, a lot of the focus is on data print in the U.S. a little bit later on this week. European stocks, for the moment, resuming some of the declines, certainly that we saw last week, shrugging off some of the tech-led gains that we saw earlier in the day. Now, we're looking at markets, of course, across the globe. What that means is that the tech is supporting, for example, some of the Japanese stocks. Now, U.S. Treasuries, I think, is probably one of the most interesting parts of the markets. This is, as we also heard from Bill Gross, a former bond king, saying that he thinks they're overvalued and that shorter end notes would make more sense for those interested in the market. So for more on what's moving the markets, we're also joined by Freya Beamish, Chief Economist at TS Lombard. Freya, thank you so much for joining us. Look, the focus is firmly on actually what's happening with treasuries and whether the market is getting ahead of themselves and pricing cuts. Where do you stand on this?
For the long term, we're very much in the camp that this is a secular bond bear market, that there's a whole bunch of different kind of secular forces that suggest that yields should be higher, and that that the average should be maintained higher in the kind of post-COVID cycle than in the 2010s. So kind of we're moving to a world of supply side shocks rather than demand side shocks. We're living in a world where there is greater kind of cost push pressure on wage growth, so inflation will be sustained higher. We're probably also the positive side of that is that we're probably moving to a world of higher real growth in developed markets as well, and there's a whole shift in the dynamic between kind of saving flows out of China and Japan into the rest of the world, which has been historically an anchor on global yields as well. And all that kind of is changing. But I think in terms of the cyclical story, we are still looking at a story, certainly for Europe, of weak growth this year, and for below trend growth of the US. Now, there's kind of two types of analysis that we do for the 12-month outlook. For the shorter term, we're looking at the kind of the survey data, and we're looking at the shorter term kind of leading indicators. And that's actually telling us that the US story may come into a little bit of a wobble, whereas the kind of the European story is looking more towards the trade data, which looks to be bottoming out. These are things that I think will turn out to be false signals, but I think markets, given the price action that we saw towards the end of last year, will be looking to that type of data to sort of push back a little bit against those kind of shorter term, those moves that got priced in towards the end of last year.
But, Freya, it's incredible to think that, the mood about the U.S. economy feels very different to what it did even a year ago, where everyone was, or most people were expecting, actually, a recession, and a pretty big one at that. Now, Odd Lots also spoke to Lael Brainard on what it will take for inflation to come down further. Here she is.
Some prices have not come down, and we're fighting pretty hard to get those prices to come down. And one area that really is difficult for Americans is healthcare affordability.
So if we look at, we're also, of course, an election year, Freya. If we look at what the Biden administration could do to try and address the high cost of living, do you worry about debt 4, 5, 6 years from now?
I'm less worried about government debt, and that might sound strange given the kind of the issuance profile that we're seeing. I think it's part of a much broader shift that will go hand in hand with higher nominal GDP growth. So when I'm thinking about the sustainability of debt and kind of support that Biden might want to offer, and the kind of the large packages that we've seen kind of coming through, I'm not just looking at that side of it. I'm not just looking at the kind of the liabilities that are being pumped out, which they are. but I'm also looking at how does that affect nominal GDP growth, and what are the other kind of secular forces that might affect nominal GDP growth. And as I said, I think inflation is going to be higher. I also think real growth is going to be higher. So as long as you're kind of the old calculus is the R minus G, your real growth versus your interest rate versus your growth rate. And as long as those two things kind of balance up, then your debt sustainability should be okay. So I'm less worried about that side of it, to be honest.
Freya, what do you think the ECB does next? And again, if you look at the politics of it all, I mean, we have a council president that's actually running at the European elections. So there's going to be the Germans and the French having to figure out who they probably put in place, with Emmanuel Macron also actually saying that his prime minister has left.
I'm very worried about the ECB policy this year. I think a lot has been priced in. If they were to actually do that, that would be great. Whether they actually kind of come through with that is more kind of questionable. And both, I think what's underappreciated is the impact of what they're doing with the balance sheet. So interest rates, to me, are clearly too high, and they're too restrictive for the economy. But looking at the QT side of things, and the idea that they might actually speed up the process of contracting the balance sheet going into the second half of the year, I'm not thinking that will actually happen, because the contraction of the balance sheet that has happened so far has already been very, very sharp. And if we look at the turnover of money in the economy, I think this is where our kind of bigger picture analysis comes in. The turnover of money in the economy, it's already quite stretched. So I'm thinking like the velocity of money in the economy. And for Europe, we're already back to those kind of pre-COVID trends, just looking at the size of nominal GDP versus the amount of money there is in the economy to operate business. That's already quite stretched. So the idea that they're going to continue with that and even accelerate it is going to be a constraint on growth, even if they're sort of looking at the interest rates and bringing that down. So they've got this kind of nasty dynamic where kind of maybe they trade off interest rates and give that to the dubs, and they look at the balance sheet and give control of that to the hawks. And it's just not a good way to run policy, because what needs to be happening now, looking at this from a kind of a longer term perspective, 12-month perspective, is very much that the economy needs actually probably even support rather than the kind of the tightness that they're exerting.
But so, Freya, apart from the U.S., where I feel like you suggest that this is going to be the strongest economy, what happens in China? Is China's also hobbled by some of the monetary policy that they've done? Is there anywhere else in the world where you see, apart from the U.S., strength?
So this is more of I can't say it's very high conviction for Japan, because there's been such a long history there of false starts. But if I'm looking to where there might be something changing in the fundamentals in the real economy, I think what I've seen in Japan is that the labor market has actually really shifted. So for developed markets in general, we are more positive for the kind of the post-COVID cycle, particularly for the US, maybe even for the UK, but also that those kinds of forces impact on Japan. And really that's about the kind of the retreat of China and rebalancing of developed markets. So that's in favor of all developed markets. But for Japan, I think what people are perhaps underestimating is the extent to which women have already been incorporated into the economy. There's a great deal of scope there to raise the productivity of the labor force, because these women are very underemployed. So if there's a kind of a higher pressure economy, which we think globally there will be, that productivity gain perhaps starts to come through. And at the other end of the demographic card, the boomers have retired. And that was actually, particularly given Japan's kind of quasi-feudal labor market, that was a very constraining factor against wage growth. You've got this big surplus at the top of the chain that has now retired. There's no longer the incentive to kick these guys out the door by cutting their wage growth in half, but they're cutting their wages, their salaries in half as soon as they turn 60. That whole dynamic is gradually passing through the Japanese labor market system. So I think when we come to the Shunto this year, we might, to the spring wage negotiations this year, we might actually see some numbers that are a little bit stronger. And that really starts to speak to some of the underlying kind of fundamental issues that have created this disinflationary scenario for Japan. So again, this is another story that perhaps there has been a rally a lot through last year for Japan. But I think kind of looking towards this year, perhaps investors will be underestimating the extent to which something fundamentally has changed in Japan.
We have a viewer question for you, Freya, and this person writing in saying, how did you reconcile the low double-digit sales expectations of equity analysts with below GDP growth in the U.S. Again, I think it just goes to the idea, is there a real big market mismatch, and how do you deal with that?
Yeah, I think there is. Sorry, I'm slightly losing my voice here, but I'll persevere. There is a mismatch between a lot of different data that we're looking at. There's a mismatch between the survey data and the macroeconomic data. There's a mismatch between kind of what we're seeing in the jobs numbers and then these kind of big revisions that we're seeing coming through as well. So this is an era where there's a big, I think, inflection point, a big kind of secular inflection point. So a lot of these kind of like charts that we're used to running between these types of things historically have worked, but when there's an inflection point, they need to kind of recalibrate their relationship, and that's, I think, what we're seeing in a lot of different data.
But does that mean? I mean, does a mismatch lead to ugly things in the shorter term before it stabilizes?
I think what we see in the shorter term leading indicators is a kind of a wobble in U.S. growth. And I think the reason why we are still more positive on the growth outlook for the US and potentially even for markets for the year as a whole is that kind of bigger picture analysis that I was presenting for Europe is in the other direction for the US. So for the US, the turnover of money is very much below trend still, below where we would expect it to be had we not been through this kind of pandemic. And that, to me, just suggests that the size of the U.S. stimulus being so large has yet to be absorbed into the U.S. economy. So when I think about those kind of short-term data, the kind of the survey data, both on the labor market, on capex, on housing, looking more wobbly in the short term, to me, that's a good thing for the year as a whole, because it consolidates that kind of impression that the Fed will actually cut, that they're now talking about kind of pulling back from QT as well, that actually in the first part of the year, some of the plumbing is more kind of positive for liquidity creation anyway, looking at the kind of the technicalities around the balance sheet. And so that all kind of suggests that there's this underlying resilience in the US economy, right, which perhaps people will kind of lose faith in because of that kind of shorter term data, if that comes through in the hard data in kind of Q1 and Q4 kind of retrospectively. But underlying, there is still a great deal of space or some space at least, for money to turn over more rapidly in the U.S. economy, and that kind of counteracts any kind of tightening of the authorities pulling money out of the economy, or through weak credit creation and these things, which would normally have much more of an effect. Going back to that kind of viewer's question, these normal effects between kind of tightening and how quickly that feeds through have all been muted. Because we've been so far from kind of what I would call monetary equilibrium, what I would call kind of a stable turnover of money in the economy. And for Europe, we're very much, I think, back to the stage of kind of people have the amount of money they need to operate goods and service purchases. But in the US, there's still a surplus there. And that gives us this backdrop of resilience in the US.
Freya, thank you so much. And certainly we've seen that resilience over the last 6 months, almost, at each data point. Freya Beamish, Chief Economist at TS Lombard. Now, let's also look at Boeing, actually, pre-market. A couple of things you need to know. First of all, the probe is focused on the door plug, as some other carriers, including Alaska Air, United, have both found some loose bolts in some of the preliminary checks, and the U.S. air safety investigator says it is not ruling out a wider MAX 9 probe. For the moment, Boeing pre-market down 0.4%. This is Bloomberg. Welcome back. Now, Boeing has issued new guidance to airlines on what inspections are required to prevent another mid-air fuselage blowout like the one on Alaska Airlines late last week. Now, this comes as United Airlines said that they found loose bolts and other parts on the Boeing 737 MAX 9 plug doors during inspections. Well, Bloomberg's Charlotte Ryan now joins us with the very latest. Charlotte, I mean, it's just pretty incredible. Like I have to say, every hour we read more stuff about it. What's the latest that we found out about the loose bolts and panels found on the 737 MAX 9?
So the latest, as you say, is that United and also Alaska have begun inspecting other planes and they have found further loose bolts. This won't be what Boeing was hoping for. The kind of ideal scenario with Boeing would be that this was a one-off, you know, an unfortunate incident. We were extremely lucky no one was hurt. But what they would have hoped for is that the rest of the fleet would be inspected, everything's fine, and you can kind of look at what you can do differently to prevent this happening. But the fact that we've already seen this in other planes in the fleet does beg the question of what is going to happen next. The actual inspections that these airlines have to carry out don't take very long. It's about 4 to 8 hours per plane. And again, in that best case scenario, that could only take a few days. But what the question now is what the regulator is going to do as a result of this. Will we see a broader grounding?
But so what happened? I mean, so this is not a problem manufacturing. This is literally like a loose bolt. And then do you need to ground the plane, or can you just kind of screw it tighter? I know this is not an IKEA shelf, but it's like, how much of a problem is this?
Yeah, so it's worth saying we don't know definitively yet what caused this. The investigation is still ongoing. We obviously are seeing a lot of reports of these loose bolts, and indeed Boeing had sent a memo out to operators in December talking about loose bolts in a different part of the aircraft. So it does look like that is the cause. The aircraft do have to be grounded to inspect them, to effectively tighten up those bolts, but it is starting to look like it's a problem, as you say, not with the manufacturing, but with the assembly of these aircraft.
Okay, I know you and your team will stay on top of that, so we'll have to, you'll have to come on to bring us any new developments on this incredible story. That Boeing probe, of course, focusing on the door plug, as more carriers have found some loose bolts. Bloomberg's Charlotte Ryan there with the very latest. Coming up, a warning to Houthi fighters in the Red Sea as Chinese shipping giant COSCO cancels deliveries to Israel over security concerns. We'll bring you the story next. This is Bloomberg. Now, the U.S. Secretary of State has said Houthi militants in Yemen must know that they will face consequences if they attack ships in the Red Sea. Antony Blinken was speaking in Saudi Arabia after talks with the Saudi Crown Prince.
We've had 40 countries come together to make clear that what the Houthis are doing has to stop. And we have other countries that have made clear that if it continues, there have to be consequences. So our strong view, our strong preference is that the Houthis get the message that they're receiving from countries around the world that this needs to stop, and that's what we're focused on.
With me now is Roz Matheson, Bloomberg's EMEA news director. Roz, we've seen the Secretary of State actually going on these short but intense trips. Is he actually hoping to achieve anything?
Well, it actually is open to debate what he may achieve from this trip. But at the very least, he's been visiting a bunch of countries in the region, Turkey, Saudi, Qatar, the UAE and more, and really collecting a sense of the mood from these countries and their concerns. And it's interesting, his final stop really on this trip seems to be Israel itself. Well, he has a bunch of meetings today with senior officials. What messages is he passing on to the Israelis from the region, and what message is he bringing from the US? At least publicly, the US has been a very strong supporter of Israel for its war in Gaza, a long-running ally militarily, strategically, economically. Behind the scenes, the messaging is probably getting a little bit more tense between the US and Israel, which is this war has gone on now for a while. Where is it going? Is the trajectory of the war changing? And what is the game plan for after the war is over? There's still Israeli hostages inside Gaza. That doesn't seem to be resolved, no progress there. And then what happens when the fighting does stop? A region that it remains very, very unstable, very, very fragile as well. Like, what happens after that? That's the big question.
Yeah, and civilians killed in Gaza, but the numbers are absolutely astounding. When you look at what he also warned a couple of weeks ago, is there a danger that this escalates?
Well, it has been a warning for many weeks now, this concern that this will bring in other actors in the region because Iran has many proxies, not just Hamas in Gaza, but Hezbollah in Lebanon, the Houthis in Yemen. We can see, of course, the Houthis have been taking pot shots with rockets and drones at shipping in the Red Sea, and that's been causing mass diversion of ships for many weeks now, and that's sort of painful and difficult for the shipping industry. But does it escalate into a full-blown regional conflict? That's always possible. Also, in a way, just because there are so many military assets in the region together, the chance of something accidental happening is pretty high. But even these Iranian proxies, Hezbollah, which is much better armed than Hamas, they know the risks if it triggers into a broad conflict. So they seem to be wanting to maximise the moment for themselves, but getting to the line where it doesn't tip into a broad conflict. No one really has an interest, it seems, in that happening.
Ros, there's also much more, public outcry from governments about what is being done to the civilian population. South Africa lodged a complaint, I think legally. Does that change tactically what Israel does on the ground?
Well, Israel seems to be doing what Israel really wants to do on the ground. They've made that very clear. Their messaging has not really changed since the war broke out, which is we will want to make sure that Hamas can never do again to us what happened on October 7. We want to take out the Hamas leadership, want to weaken it to the point it can never surface again, which is obviously easier said than done. But we can see they're moving towards this sort of surgical strikes, tactical attacks on the leadership and drawing criticism as a result.
Ros, thank you so much. As always, Ros Matheson, their Bloomberg EMEA News Director. Coming up, GSK announces plans to acquire an asthma specialist in a deal worth up to $1.4 billion. We'll be discussing M&A next. This is Bloomberg. Boeing 737 MAX 9 fallout continues as United and Alaska Airlines find loose bolts on some planes, dealing another blow to the troubled plane maker. German industry shrinks for a 6th month as a recession looms in Europe's biggest economy. Plus, the French Prime Minister Elisabeth Borne steps down as Emmanuel Macron seeks fresh momentum for his agenda ahead of the European elections in June. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So GSK has announced a deal to acquire the asthma specialist Aiolos Bio for up to $1.4 billion. Now, it comes after the chief executive, Emma Walmsley, said she was on the hunt for acquisitions in the drug maker's core business. It is a promising start for M&A this year after a disappointing 2023. Or is it? What else can we expect? We're now joined by Dwayne Lysaght. He is co-head of EMEA M&A, that's a mouthful, for January 9th for JPMorgan. Dwayne, thank you so much for joining us. This is like a good reset when you look at, the pipeline for the next 12 months. Is it looking good or is it harder because of the credit conditions?
Well, thank you very much for having me on. Happy New Year to you. It is a good start. And actually, when you look at healthcare alone, we've had over 8 billion of deals announced in the last 24 hours. So our hope is that this is a good start for a better year. I think last year undoubtedly was tough throughout the world, particularly in EMEA when you look at absolute volumes. But I think it's a different year, we think. I think hopefully we have a little more tailwind and less headwind. There are the geopolitical, macroeconomic issues, but helpfully inflation seems to be under control. And interest rates, if anything, it's sighting downwards. And if you look at Fed rates, the market is suggesting 75 basis points by the end of the year. That all helps the key component of M&A, the psychological side of confidence. And I think people are generally pent up to get deals done.
But Dwayne, what happens as we reflect on 2023? Because I think it's quite important to reflect and then look forward. Why were there not that many deals? Because you can not buy a company because you feel nervous about the future. You can not buy it because you don't have the money. Or you can say, actually, I'll buy it for this price. But the seller just wants so much more. Yeah,
and I think that valuation mismatch is gradually coming together. I'm not saying it's there, because I think there is still a mismatch between buyer and seller. And sellers, frankly, have long memories and buyers have short memories. But that is going to tighten this year. And I think it's going to be helped by banks who I think are in a better position to actually finance deals, hopefully at lower costs. And the overall kind of consumer outlook hopefully will get better if we can avoid that recession potentially in the US and have a softer landing. All of these things do help the confidence level. But every now and then you get a cycle in M&A. Right. And I'm hoping that 2023 is that trough. And that actually we push forward from here. We had to go back in EMEA, back 20-odd years to get a year that was lower in volume terms. That puts it in context. But if I take one star from last year, it was the December run. Yeah. The Q4 was 33% of M&A and EMEA last year, and hopefully this is a bit of a springboard into 2024 and beyond.
I mean, is that also because markets are expecting actually interest rate cuts? Again, how much do they think about geopolitics, yep, and how much is it actually the financing longer term?
I think geopolitics are a very important part of it. Now, we had clearly the Middle Eastern crisis in October, and that definitely dampened things. But I think people started to look beyond that to the wider macroeconomic situation. And we had that significant run in equity markets, particularly in the US, from October through to December. S&P returned 24% last year. So I think, again, that adds to the confidence. Maybe people are getting back, investing the money, hopeful that they can actually get the return they're anticipating. And
Dwayne, where are you most optimistic in terms of sectors and in terms of region? Is this cross-border or is it actually inter-domestic buyout?
We think cross-border will be healthy. No. I think in EMEA it's probably more local proportionally. And, UK was a difficult year. If I take one particular market, it was down over 40% in announced volume. So our hope is that we see that coming back next year. And I think it'll be led by the bigger markets. It will be the, France, Germany, Nordics is probably the key countries. And then when you look at sectors, we had a very strong healthcare last year. It was up 60-odd% in EMEA, but I think it'll be led by the stalwarts of diversified industrials and then energy, power, etc.
But healthcare, is it also because it was, already ripe basically for acquisitions because we hadn't seen that many in the last 10 years?
I think in portion, but that I think in many ways is the point. You get this kind of pent-up demand and then it goes. Right. And I think we're going to see that, sector by sector, country by country. We are cautiously optimistic. At the end of the day. And our hope is that the momentum that has been created at the back end of last year will continue. A lot of it is down to confidence, but we see that returning.
Dwayne, what do price mismatches look like in the UK? Again, are sellers trying to adjust to what a buyer will pay for it? Because they look at the next 12 months and they say, look, it's going to be okay, but it's not going to be great. Better sell now.
Yeah, I think to a point. I think they are... assets that are selling are generally good quality assets that people actually want almost no matter what. And I think what we'll see now is that actually the slightly more marginal assets will come through because people say, actually this is my time, my opportunity. And when you look at the market itself, it was the bigger deals that didn't happen. But actually when you look at the sub $5 billion, it was only down 10%. And actually, interestingly, the $1 to $5 billion market in EMEA last year was flat. Right. On 2022. Yeah. So I think there is hope when you look at it. Bigger deals, we suspect, will start to come back. Yeah. Why? Financing markets are better. And people are saying, now is the time to get on with things. I have a strategy. I need to deploy it.
Dwayne, I'm going to throw you a curveball that only JPMorgan bankers can deal with. Are elections actually an accelerator for M&A? So we have the UK election, we have the US election, we have European parliaments. Do people think, actually, I don't really know what comes next? Better sell now? Or is it, again, like priority number 6, 7, or do they just not really think about it?
I think they do think about it. And when you look at it statistically, actually election years are often quite good years. Presidential election years in the US are actually good years for M&A, generally speaking. But to your point, Francine, we have the largest number of people going to the polls since 1800. Yeah. I think it's 49% of the world's population,
it's incredible.
Which is a huge number. So will that interfere? I suspect it will. It creates a kind of attention as to what will happen. But actually, we find that incumbent governments or potentially new governments tend to work with the business community 12, 18 months beforehand to say to them, if we're in power, actually this is what it's going to look like. And I think a lot of that is being done around the world. So I take hope in that it's more of a glide path rather than a sudden impact by any election.
Is there a period in the year where M&A is usually more active? So I know, again, it's not like a house sale, but there do tend to be more house sales in the summer.
Exactly. The summer tends to quieten down. Okay. And you're usually I tend to look at what does the start look like? Is it a fast start, which often helps, if anything, back to the confidence point. And then the last quarter, in terms of people trying to get the deals done, set themselves up well for the next year. And actually, when I look at our own pipeline, that is very much what we saw. We saw a lot of clients coming to us and saying, I want to get ready, I want to get started. And that is where I'm kind of hopeful. But I say, cautiously optimistic rather than outright, it'll be fantastic.
Dwayne, thank you so much for joining us.
Thank
Dwayne
you very
Lysaght
much.
there from JPMorgan on M&A this year. Now, let's also look at one of the most read stories on the Bloomberg terminal right now. Shares and bonds of Spanish blood plasma firm Grifols tumbling after the short seller Gotham City Research published a report criticizing the company's financial reporting. Now, Grifols issued a statement just moments ago saying it categorically denies and actually rejects any allegation of wrongful accounting or reporting practices. Still, on the back of that, Grifols pre-market is dropping some 43%. That's a pre-market trading for Grifols. Now, coming up is crypto on the cusp of its first institutional bull run. We take a closer look ahead of a key SEC decision on the first U.S. Bitcoin ETF. That's next, and this is Bloomberg. Welcome back. Now, we just want to show you what Grifols has been doing. We showed you the ADR, and this is pre-market ADR of Grifols. Let's also show you what's happening, actually, Grifols in Spain. Now, shares and bonds of the Spanish blood plasma firm Grifols are really down 38%. This is after a short seller, Gotham City Research, published a report criticizing the company's financial reporting. They have, just a short while ago, completely denied any of these allegations. So we'll bring you everything that we know about Grifols. Again, they have said it's just not true. Despite that, actually, Grifols down some 37.6% in Spanish trading. Now on to Bitcoin, and it's steadied after briefly rallying past $47,000. That's been driven by optimism that regulators are set to approve the first U.S. exchange-traded fund investing directly in the world's largest digital asset. Well, the executive chairman of Phoenix Digital Assets, Jonathan Bixby, joins us now. Jonathan, great to have you on the program. I mean, this is exciting and terrifying at the same time, because since last time we spoke, I mean, everything and anything's happened to Bitcoin and some of the exchanges. I mean, do you expect the SEC to approve this ETF, and how big a deal would it be?
Yeah, so I do. I mean, I think that the SEC has been put into a bit of a corner through some of the legal, the lawsuits that have happened. I think that there are really smart financial operators like BlackRock that have come out publicly endorsing a product. I don't think that happens. BlackRock's pretty smart, and Larry Fink's not going to go out and endorse something unless it's going to get through. And I think fundamentally the SEC can't say no at this point. So I expect it in the next 48 hours.
Okay, and so if it's approved, what happens to Bitcoin, shorter term and longer term? Is it a real boost?
I think it is. I mean, I think you have to understand it almost like a trade deal between crypto world and fiat land. So for natives like me, I live in a different world. I live in a digital world. That world is a world of growth, productivity, very little debt, because it was essentially wiped out in the last bear run. And in the fiat world, we live in a world of low productivity, aging population, and a ton of debt. And what this really is a trade deal so that people in fiat land can get money into crypto land in a safe, regulated way. And I think this is about 15 years in the coming.
But so where are we on crypto land? Like, we recently interviewed the new Binance chief executive.
Yep.
I have to say, we were expecting more in terms of news on how to change the exchange and I guess, make it regulatory, or being able to put it in a place where it would have regulation approval. And we didn't get many answers on that. So there's so many question marks about what happens next.
Yeah, I think crypto land is an emerging economy. It's no different than any other emerging economy. And so in emerging economies, you have risk and you have high reward. And because of that risk, people have been scared to, for example, custody their coins with a group like Binance or FTX, because what happens if they go out of business? It's also really difficult to custody your coins yourself. You have to be a technologist, and you don't want to lose them in a dumpster somewhere and wind up losing hundreds of Bitcoins, right? So I think that what the ETFs really do is they take a lot of that complexity away and allows you, someone in the mid-U.S. who wants to put 1 or 2% of your portfolio into this new economy, you can do that in a safe, regulated way. And I think that's an earthquake of demand coming to the crypto market very soon.
I have a viewer question. Actually, I have many viewer questions for you, Jonathan.
Good.
So thank you so much for viewers that are writing in. Why is the ETF approval much different than MicroStrategy, MSTR already being a proxy for Bitcoin?
Yeah, MicroStrategies would be a proxy for Bitcoin through what Michael Saylor has done in terms of bringing that onto the balance sheet. Okay. I think what brokers are looking for is a little bit more certainty. And the ETF market, as you know, is a very low fee way of getting large amounts of capital in a simple way into an asset class, gold being the best example of that. And so I think what brokers are looking for is a way to make money, and B, a way to scale this industry in a way that's been done before. So yes, you could buy Coinbase as a proxy, you could buy crypto miners as a proxy, you could buy MicroStrategies as a proxy. That's not really how these markets have developed over time, and I think BlackRock and Fidelity know that.
So there's BlackRock, there's Fidelity. Will others actually take this more seriously if it does get approved? I
think the answer is fundamentally yes. You have some of the largest institutional capital moving into this market. I think that having Fidelity and BlackRock at the front of that, including Invesco and some other smaller ones like ARK, makes this a very legitimate asset class, both for retail customers and I think institutional flows. So I think institutional flows like pension funds are now going to start moving money into this asset class in a way that just hasn't happened in the last 15 years.
Jonathan, I also want to ask you about, NFT. So you launched NFT investments, and they've slumped quite hard over the past year. Again, is this a fad? Does it come back? We don't really talk about NFTs anymore.
Yeah, I think that what happened in the last run, and we've had many of these, right? So anyone who's been in crypto has seen the bull and seen the bear. The volatility is huge. I think what we've seen through all of those volatile moments is growth. So the number of wallets, as an example, last year the market went down 80%. Everyone got wiped out, a ton of bankruptcies and criminal proceedings. And guess what? Population grew 2x. So there's 2 times more wallets in the industry today than there was a year ago. And that's because venture capital, who was seeding the market, put $67 billion to work in 2020, 2021. That is now coming out into this cycle. So whether it's NFTs, whether it's ticketing, whether it's rapid trading, which is happening on the Solana network, all of these use cases are coming. It's early days. This industry has only been around for 15 years. And so I think that as you see the next 10 or 15 years, this emerging crypto land, this digital economy, is, I think, a place where people want to have some upside, and that's where the ETFs come in.
So where do you see opportunities now? How's your funds, how are they changing?
Yeah, so I think there's 2 sides of this. There's the supply and the demand side, right? So the demand side, we've never seen a demand earthquake like the ETF that's happening. You have to remember that there's also a supply earthquake that happens in BTC every 4 years. And what happens is every 4 years there's something called the halving, which is going to happen in April of this year. It's going to get it twice as hard to mine BTC. So it's inherently a deflationary event in crypto. So I think what you're going to see, if you answer the question explicitly, is you're going to see a lot of money moving into BTC, which is the large cap, and a lot of money moving from that large cap down into small caps. And those small caps are altcoins like Ethereum and Solana. And you're going to have more infrastructure being built on these pieces over time. So digital crypto land is a growth area. I don't feel as good about non-crypto land at this point.
But, Jonathan, so what do you need actually for I guess, the big, better-known players to come into crypto land to make sure that it's clean money, which is, frankly, then the biggest concern, full stop?
Yeah, so I think you need, in 48 hours, the SEC to
come in
put a stamp
and say,
of approval, even though Gary Gensler doesn't want to. You have that stamp of approval, which says, hey, this is now a regulated space for you to store some capital. Which, again, is inflows into the system. I can't underscore enough how important that is for the industry.
But to do that, they need to be sure that it's clean. Otherwise, the SEC will pay the consequences in a couple of years.
That is correct. And I think that the SEC has gone over and above to determine that the entrants into the ETF market are clean.
Okay. Jonathan, thank you so much for joining us today. Executive Chairman of Phoenix Digital Assets, Jonathan Bixby. Now, coming up, the top 50 companies to watch in 2024, from artificial intelligence to autos. We'll have the full breakdown next, and this is Bloomberg. Tiger Woods and Nike have ended their partnership of more than 27 years. The company struck its first deal with Woods in 1996, the year he turned professional. But unlike subsequent deals with NBA stars LeBron James and Kevin Durant, Nike did not sign him for life. It's estimated that Woods earned about $660 million from that relationship. Now, the 48-year-old posted on X that there will certainly be another chapter. Now, on to other news, and Bloomberg Intelligence has identified 50 companies from finance to food that warrant a closer look in 2024. Their analysis combines contrarian views on upcoming catalysts for change, such as new leadership, asset sales and acquisitions, as well as plans for new products and services. Now, this is one of my favorite segments in January. For more on this, we're joined by Tim Craighead from Bloomberg Intelligence. So, Tim, this is like Omen's work. I mean, it takes a long time to put it together. Give us a little bit of a brief background on why you do this and how you select the companies.
Yeah, absolutely. It is no doubt one of the favorite things we do every January. We've done all the work on the outlooks across markets and industries, and this brings it down to a group of 50 companies that we think are notable. They're part of our broader list of focus ideas with three things in mind: a really strong fundamental view that we think, number two, is different from the market, and number three, they're catalyst ahead, in particular in this case in 2024, to make the stories come around to what we think, assuming we're right.
Okay, so if you look at some of the names, AI, left, right, and center.
Yes.
Tell us more.
So AI is the most pervasive underlying driver. We think 2024 is going to be really interesting, combining sort of the movement of experimentation actually into implementation at the same time that there's a backdrop of an IT spending cycle that comes back into favor in the second half of the year. So you've got big companies that provide the infrastructure like an Alphabet or an Amazon with AWS underneath of it. But you've got an SAP that provides the data with their enterprise planning systems. You've also got some application companies like Intuit, which was a tax prep software program in the U.S. that's implementing AI to make it easier, or Match, if you want to get fun. Think Tinder, think Hinge. There's elements of better photo selection with AI. So AI is quite pervasive, and we think it accelerates. And
then, of course, the other, I guess, big thing is this pivot that we may or may not see, but certainly the markets thinks that we're seeing from central banks.
Yes.
How does that play into company selection?
So interesting. This was a big topic last year, but it was with a wind at the back, thinking that we're going to see margin expansion for financials. This year, as we look towards a pivot towards easing and lower interest rates, it's a headwind for margins, and we're generally concerned about European banks. Barclays is on the list with that in mind. AXA is an insurance company, a similar sort of thesis, plus some regulatory change that makes it even more sensitive. But there are positives. UK home builders have been under a lot of pressure. Persimmon, we think, could actually be better than expected in terms of where its business goes.
And then you have a bunch of companies that are basically looking at restructuring or have new chief executives.
Indeed. Think Vivendi from a restructuring perspective. We thought last year largely it was going to be this big mega entertainment company, but now they look to be splitting the company up. SABIC in the Middle East is going to be selling off its steel business and focusing in on petrochemicals. Management change, think Union Pacific with a new CEO, or here in the UK, British Telecom, a perennial disappointer that we think with a new CEO actually could turn into positive, not negative surprises.
Tim, thank you so much. And where do I find it? On the website?
On the website,
on the Bloomberg
and
terminal.
we will find it on the Bloomberg terminal as well.
There, or you can email Tim and he'll just send it to you. Tim Craighead there from Bloomberg Intelligence. Up next, Bloomberg Brief, Daniel Manis from London and New York. This is Bloomberg.